Welcome to Tax Smarts Unlocked, the podcast for individuals and small business owners looking to conquer the tax landscape with confidence. Hosted by seasoned tax professional David Robson of Premier Tax and Business Services, each episode is packed with insightful advice on proactive tax planning to help you navigate the complexities of tax laws. Here's your host, David Robson.
Welcome to Tax Smarts Unlocked. I'm David Robson, and today we're decoding the tax benefits of flexible work arrangements, how to support a remote team and legally pay less tax while you do it. Flexible work isn't just an HR strategy, it's a tax strategy. When employees work from home or on the road, the tools, space, and travel they need can often be turned into deductible business costs or tax-free reimbursements. Done right, that boosts morale and cash flow. Done wrong, it creates taxable stipends, payroll tax bloat, and messy audits. Over the next 10 minutes, I'll cover accountable plans, home office rules, equipment expensing, co-working, travel, fringes, health reimbursements, multi-state payroll and nexus, and the documentation that keeps you out of trouble. Let's turn flexibility into measurable savings. First, why flexible work is a tax conversation. Because support you provide to make remote work possible can usually be a legitimate, deductible business expense. But the rules split sharply between employees and the self-employed. Under current federal law, most employees cannot deduct unreimbursed job expenses, including home office costs. That deduction was suspended, so the home office break is effectively off the table for W-2 employees. Self-employed folks, however, sole proprietors, single-member LLCs, taxed as disregarded entities, still can take a home office deduction if they meet the tests. For employees, the move is different. Set up a strong, accountable reimbursement plan so the business picks up necessary costs tax-free. Same outcome, expenses recognized for tax, different path. Get this distinction wrong, and you either overpay tax or frustrate your team. Let's unpack the accountable plan, the engine of tax-efficient remote support. An accountable plan is a written policy that allows you to reimburse employees for business expenses without treating those payments as wages. To qualify, three things need to happen. The expense must have a business connection. The employee must substantiate it in a reasonable time with receipts or an expense report. And any excess advances must be returned in a reasonable time. Many companies use practical guardrails like 60 days to submit, 120 days to return excess, and monthly reimbursements. Keep the policy in writing, apply it consistently, and store receipts or digital copies. With that in place, internet, cell phones, office supplies, and even the business share of utilities can be reimbursed tax-free and fully deductible. What should you reimburse? Start with the business portion of home internet. Many teams default to a flat percentage, say 50%. But ask employees to note their work pattern so you can defend the number. Cell phones are squarely supported by IRS guidance. If you provide or reimburse a phone for substantial non-compensatory business reasons, like need to reach staff or on-call duties, the reimbursement is excludable, even if there's incidental personal use. Add office supplies, printer ink, postage, and ergonomic gear like chairs or monitor arms, provided there's a documented business purpose. Modest utilities tied to the home workspace can qualify under a home office reimbursement. The big caution: avoid the taxable stipend trap. A flat 150 remote allowance with no receipts is treated as wages, subject to income and payroll taxes. Under an accountable plan, the same money, properly substantiated, is tax-free. Let's put numbers to it. Suppose you pay 10 employees $150 per month remote stipend with no substantiation. That's $18,000 a year of taxable wages. You'll owe roughly 7.65% in employer FICA, about $1,377, and employees owe income tax plus their own FICA. Swap that stipend for accountable plan reimbursements, say $60 internet, $40 phone, $50 supplies or ergonomic gear on average, all with receipts, and the business still deducts $18,000, but none of it is wages. You save the payroll tax, workers' comp premiums may drop, and your people keep more in their pockets. Same cash out, smarter tax treatment. The key is documentation, expense reports, recurring reasonable percentages, and a clear policy describing what is reimbursable and why. Owner-employees of S-Corp and LLCs taxed as S-Corp should pay special attention. Many owners try to rent a home office to the company. That can create messy self-rental issues, a separate lease, and potential recharacterization. A cleaner approach is to use the accountable plan to reimburse the employee owner for a bona fide home office. Calculate the business use percentage, often by square footage, and reimburse a share of rent or mortgage interest, property taxes, utilities, insurance, and repairs, excluding the land portion and personal improvements. Keep a simple worksheet, floor plan, and copies of bills. Process it monthly or quarterly like any other expense report. The corporation deducts the reimbursement. The owner-employee excludes it from wages. No Form 1099 rent, no payroll tax, and the company avoids potential under-market lease scrutiny. Simpler, cleaner, and commonly preferred by tax pros. Self-employed. The home office deduction still lives. 2 tests, exclusive and regular use, and it's your principal place of business or a place to meet clients. Exclusive means a defined area used only for business, not the dinner table. Choose the simplified method. $5 per square foot up to 300 square feet, max 1,500, with minimal records. Or use actual expenses, a percentage of rent or mortgage interest, property taxes, utilities, insurance, and depreciation. Actual may be larger, but depreciation can be recaptured on sale. Many prefer the simplified method to avoid that. Example, 300 square feet equals a 1,500 deduction. At 24%, roughly $360 off income tax, plus possible SE tax savings. Let's talk gear. It's usually better for the business to own or reimburse equipment than to have employees buy big-ticket items personally. Employer-provided laptops, monitors, docks, headsets, and printers are typically 100% business use. For tax, consider Section 179 to expense qualifying equipment subject to limits and bonus depreciation where available, phasing down to 60% in 2024 unless extended. For cheaper items, the de minimis safe harbor lets many businesses expense up to $2,500 per invoice or item, $5,000 with an applicable financial statement with a written policy. If employees already own gear, reimburse only the business share under the accountable plan and document the percentage. Clear ownership and custody policies also help IT security and keep deductions clean. Co-working can be a productivity booster and a deduction. Memberships or day passes used for business are generally deductible, and they help employees in small spaces separate work from home. Document the business need and usage. One caution, putting an employee in a regular co-working site out of state can create tax nexus for the company. More on that shortly. Travel also shifts with remote teams. If an employee's tax home is their residence and you haven't assigned them to a permanent company worksite, occasional trips to headquarters are business travel, not commuting. Use federal per diems under your accountable plan for meals and incidentals. Reimburse lodging with receipts or approved per diem rates, and keep agendas and approvals to support it. Flexible work pairs well with smart fringe benefits. Working condition fringes let you provide items employees could deduct if they paid, professional dues, certifications, or business-only software, tax-free. De minimis fringes cover occasional coffee, snacks, or nominal gifts. Keep them infrequent and low value. Education assistance programs can reimburse up to $5,750 per employee per year for qualified education, and through 2025, that cap can include student loan repayments. Dependent care FSAs allow up to $5,000 per household, $2,500 if married filing separately, pre-tax for eligible childcare. For health coverage in a distributed team, small employers can use QCHRA to reimburse individual premiums and qualified expenses tax-free if no group plan is offered. Growing teams can consider ICHRA, which allows reimbursement classes and integrates with individual plans. Now, the multi-state reality check. Where your employee performs services generally drives state income tax withholding and unemployment insurance, so register for payroll in that state even if you have no office there. One remote employee can also create income tax and sales/use tax nexus. Expect returns. Watch convenience of the employer. Rules in states like New York, Delaware, Nebraska, and Pennsylvania, which may tax non-residents working at home unless the employer requires the out-of-state location, potentially triggering double tax unless credits or reciprocity apply. local taxes matter too. Cities with earnings or wage taxes may allow refunds for days worked outside city limits. St. Louis and Kansas City have specific processes. And remember, remote does not equal contractor. Apply the common law and any state ABC tests to avoid misclassification penalties. Let's land this plane with documentation, pitfalls, and steps. Put telework agreements in place that set the employee's work location and outline equipment ownership. Keep written expense and per diem policies, require receipts or reasonable percentage methods, run periodic reviews to true up internet, phone, and home office reimbursements. Avoid pitfalls, calling everything a tax-free stipend, reimbursing personal furniture with no business purpose, double-dipping deductions between the employee and the business, and under-withholding in the wrong states. Year-end housekeeping, verify state registrations, reconcile payroll for multi-state withholding and SUTA, audit reimbursements for substantiation, true up per diems, and make sure W-2s reflect taxable items. And when to call a pro? Designing an accountable plan, multi-state payroll and nexus, equipment expensing, and owner-employee reimbursements. Thanks for listening to Tax Smarts Unlocked, where flexible work meets tax planning.
Thank you for joining us on Tax Smarts Unlocked, the ultimate podcast for individuals and small business owners ready to conquer the tax landscape with confidence. Hosted by seasoned tax professional David Robson of Premier Tax and Business Services. Each episode has been carefully crafted to provide you with insightful advice on proactive tax planning. By adopting a smarter tax approach, you can focus on what you do best, growing your wealth and your business. We're here to guide you every step of the way. Don't miss an episode. Subscribe to Tax Smarts Unlocked on your favorite podcast platform and unlock the secrets to confident tax planning. Remember, it's time to take control of your taxes and unleash your full financial potential.